Hey folks, this is Clayton Collins, CEO at HW Media, and your host for the Housing News Podcast. This week's guest on Housing News is Mr. Mike Simonsen, the founder at Altos Research. I asked Mike to join us on Housing News this week to talk about how he uses active listings data, pendings data, and other real estate and economic data sources to better understand the U.S. housing market. In this episode, Mike shares a glimpse into the data that he is seeing this week, this really pivotal week in the first week of May of 2023, as we start to see total active listings climb into the summer. Mike also goes out on a limb and shares some forecasts that he sees in the market for summer 2023 and where he thinks we'll end the year in terms of total active listings. Mike gives me some lessons on exactly how we can best use information to understand what's happening in the housing market for real estate agents, loan officers, and investors, and also sheds some light on some misperceptions and ways that people use real estate and housing data incorrectly. I hope you enjoy this episode with Mr. Mike Simonsen, founder of Altos Research.
Hi, this is Sarah Wheeler, editor-in-chief of HW Media, and I'm talking to Ed Messman, CEO at Rook Capital, about their shared value investment program. Ed, how do you engage investors through the platform?
Yeah, ideally, we look for investors who are interested in their local communities. These are banks, individuals, family offices, foundations, employers. They all care about the fabric of their own communities. They all want to see families move back into those communities and raise their kids. Those are the types of investors that we are seeking and who are most interested in what we're doing.
Thanks, Ed. And listeners, you can find out more at rook.capital.
Yeah, it's the first few weeks when we started to see inventory climb. I was cautiously not talking about it because I wanted to make sure this was a trend line that was going to stick. But I feel like as of your Monday, May 1st update after our weekend analysis, we feel like we actually have a trend line that is moving up and to the right, which is it feels like something we can talk about now.
Right. Like inventory is rising. I expect it to rise another couple percent this week. Yeah. You know, it's 2 weeks or 3 weeks in a row. Like it feels like we have rounded the corner and it's okay, right? It's a very healthy number to, you got to list it now so they can be bought in the next few weeks.
Yeah. Really interesting. All right. So Mike, I want to go into forecasts, but I have one kind of last question on active data before I'm going to make the audience wait for some forecast information here. So what is, if there are any misperceptions about the way people use active data, or the way people think about listings or pendings, and kind of your years of watching this data and talking to people about your analysis, what is something you kind of think the market misunderstands about how to interpret, how to use, how not to use active data?
So I think the biggest misinterpretation we get right now is actually the seasonality one. When I was pointing out in February and March that inventory is falling, the critics, which I have a few, they would say inventory always falls in February. It's seasonal, and I was like, man, the weekly change is not seasonal, and it's the slope that we should be paying attention to here. Or, likewise with the price reductions data, this year we started with almost 40% of the market having had price cuts. And that's a lot. It's a lot more than any recent years. It was a reflection of, ice cold demand in the fourth quarter. And so, price reductions, like you get some new inventory and the inventory is on for a few weeks and then that they start doing price cuts. So usually price cuts bottoms in February or March and starts climbing up. And so this year, price reductions as of this week are still falling. Fewer and fewer homes, percentage of the market, fewer and fewer homes have had price cuts. And that's later in the season because we had restricted supply and we had enough buyers at these prices, this price affordability. And so, the misperception is that, I would say, man, price reductions are falling. And people would say, well, price reductions always fall this time and price reductions are higher than they ever were. But really it's the slope, it's that change in that data that was so meaningful to me this year. And I try to point that out to folks.
Yeah, I feel like Logan Motosciani may have rubbed off on me a little bit too much. I almost just said be the detective, not the troll. But when you when you talk about price reductions, I think it's really important to set the stage with historical context, and so the current week price reductions. Do you have that percentage off the top of your analysis?
Yeah, the current week is 29.2% of the homes, all the single family homes on the market have had a price cut. If you go look at all of them, 29.2% have had a price cut.
And if we go back to kind of like pre-COVID years, or look at like a 10-year like trended average, we're looking at like around 40% is kind of the average like market price reduction.
No, 30% is
30.
actually normal.
Okay.
30% would be normal. The last few years have been hotter than normal. And so it's below 30. Earlier in the decade, it might have been 35% would be normal. In some of those boom markets like Phoenix, it's normal to be over 40%. And in some of the hotter California markets, which have chronically shortage of inventory, like it's more normal to be closer to 20%. But 30 or 33 is a good rule of thumb. About a third of homes are overpriced. They take a cut before they sell.
And we all like to like simplify things to the fullest. And I know that's one thing that you've helped your clients do at Altos with the market action index is that the price decreases something that plays into your indication of like buyer or sellers market. Cause I'm, as you talk about this, I'm kind of sensing that like if 30 is the average and we're at 29 right now or 28 right now, that might be a reason we're still kind of slightly tipping into sellers market, but you go over, you have a different environment.
Yeah. So the market action index is designed to just at a glance, how's the market? I don't know what it's doing in Kalamazoo, so let me go look. And so the way the math works is it takes us supply versus demand. And as I pointed out, you can't really use the sales rate to understand demand. So we have to do a few proxies for demand in that math. And so the market action index in a lot of places around the country is still in seller's conditions. And it's really because, we have less than half the inventory than we normally have. We like this time in 2015, we had 1.2 million homes on the market. And there's 420,000 right now. And so, and 2015 wasn't that bad, right? Like it wasn't like a, ice cold buyer. It was already coming out and pretty robust at that time. And so being in this, we've been in a seller's market, and because inventory is so restricted, if you are a seller with a good property at the right price, you're selling your home. And if you're a buyer, like the ones that are the good quality homes, there's competition, even though it's significantly less affordable than it was a year ago, right? And there are significantly fewer buyers than there were a year ago. A year ago, you look at the market action index in any random part of the country, and it's like floored. It was 100 miles an hour. We were going super fast, and that's not the case now. But inventory is still restricted based on any reasonable estimate of where it's been recently.
We'll save our audience from a conversation about mortgage rates today, and not draw that correlation in there. So Mike, I was shocked in your recent YouTube video to actually hear you start making some forward, some pretty putting a number on paper of some forward-looking views. Do you want to talk about what in the data is getting you comfortable making some forecasts for summer and end of year inventory numbers, and share with our audience how you're thinking 2023 is going to play out?
Yeah, we don't publish as a product, forecasting numbers, right? So this is me looking at the data and interpreting what I think is going to happen for the year for 2023. There are a couple of things, right, that are interesting, like where price is going to go and where is inventory going to go. Inventory follows a pretty seasonal curve, right? It's usually starts climbing in the second to third week of January. Maybe it's a little bit later in February, and it starts climbing up. It peaks in the late summer and starts curving back down. And you have this little, sine wave S curve through the year. Last year, inventory, the market slowed way down, and it was a dramatic shock how much rates rose. And so inventory rose pretty dramatically. And if that had continued this year, we would see, we expected maybe we'd had 700 or 800,000 homes on the market by the end of the year. As of right now, though, because inventory has been decreasing, we can really see that we'll probably end the year with about the same as we started the year, maybe a little bit lower. So that's 500,000 homes, in around 500,000 homes. If the economy slows hard in the third or fourth quarter, maybe that we raise that up. If a deep recession doesn't really hit until later, then maybe that number actually falls lower, and we shrink inventory year over year. So the first thing I'm thinking about is about 500,000 year end homes on the market.
That prediction is like contingent on like a couple different things happening. There's a couple different ways we get to higher inventory. So we get to higher inventory because the supply demand imbalance starts to switch or kind of find equilibrium or kind of flip in the imbalance. And we start to see more supply come to market and demand isn't there, probably because of economic conditions like job losses and wage growth. People just, the buyers aren't there. The other way we get there is interest rates cooperating, and we see more homeowners list existing properties, which just brings, and yes, those home owners turn around and buy something new, but it kind of adds a lubricant to the ecosystem, and we see inventory increase that way. And the real, theoretically for me, the challenging part of figuring out which path we're going to follow is that for interest rates to cooperate, we probably need some economic conditions to head in the wrong direction. So the same scenario, which gets us to an unhealthy supply-demand equation, is the scenario that gets us to lower or more stabilized interest rates.
That's really fascinating. Yeah, and what if rates do the other thing? What if rates spike from here because the economy isn't slowing down?
And does anyone rush to the gates? Does anyone got to buy now? Rates are going up.
Right, rates are going up. I don't know if they do, but they could hit the brakes again, right? Yep. And so buyers hit the brakes, and that's what happened in September and October last year. And so last year, very unusual that inventory started rising in the second week of September through October with rates, when rates went over 7.5%. Like that stopped people cold. And I think what we're seeing, and so that could happen again. I don't know, maybe rates go up there and that could happen. But outside of that, that's one way that inventory could rise in that sense. One of the things is I talked about distressed sellers. We could also have investors that need to unload properties. So we've built a lot of investment properties over the last decade. Americans, own record numbers of investment properties. It's mostly mom and pop own 1, 2, 4 places that size, like 90% of the market. And so if there are those folks who find they can't make rents and they lose their main job, like maybe those have to hit the market. We know that those investors slowed down their purchases last year, especially the big investors. But we also know that none of them have sold anything. And I talked with Gary Beasley, who's the CEO of Roofstock this year, who Roofstock deals with investors of all scales, from the biggest institutional all the way down to the individuals. And he said, none of them. I know all of them, and none of them are selling. And so, maybe that is a place, there's some condition, rates, or I don't know, economy that forces them to start selling some of those. As of right now, none of those folks are selling.
And the ones that I talk to are still fundraising and ready to get back to the buying behavior.
Ready to deploy, right? So if any price reduction happens, the cash is there. You get to a certain cap rate and they'll take everything. Like there's a floor on pricing.
Oh, now that tech investing has been such a roller coaster for investors, people are hunting for yield, and I think real estate as an asset class they're not quite done with yet.
Yeah, it sure feels like it. I don't analyze investors, so but it sure feels like that to me. Like there seems like that is one of the factors that's been keeping demand up, keeping a floor on prices, all of those things.
All right, Mr. Simonson, thank you for sharing your expertise, everything you've learned as you've analyzed active listing data and better understand what's happening in the housing market for real estate agents, loan originators, investors, everyone else who everyone has a stake in the game that is single family residential housing. Appreciate you sharing your expertise.
Clayton, it's always fun.